Okay, hello everyone and good morning. Very happy to be here just to talk to you guys about your 401k plan. I am here with my colleague Dave Treadle just to give some insight into your plan with the purpose of educating you, helping you feel very confident and good about the plan, the 401k plan that you guys have, and really to encourage you to make maximum use of this awesome benefit. First, I'd like to go through a couple of housekeeping items. Just like to mention again that this presentation is really meant to be educational and somewhat general in nature. We're not really giving specific recommendations to any of you guys just because everyone's situation is a little bit different. And so we do have the opportunity to have a one-on-one with Dave after this is over. I think the link to scheduling is in the your calendar invite for that. So I would really encourage you if you have some questions that are specific to you to take advantage of that benefit. Also, there's a question and answer box. So if you have any questions while we're going through this presentation, I would encourage you to have those questions. We'll pop on at the end just to kind of go through any questions we receive and clarify anything that may have come up that doesn't seem clear to people. So take and use that question field there in Zoom. So again, I'd like to pull on Dave now and just to introduce him. He has been in the industry for a long time, almost 15 years. He is CFP, and he's been working with your plan with me for a couple of years. And so he's pretty familiar with the plan and all of the investments and really the stipulations. So at this point, I will turn it over to Dave and let him get started.
Yeah, thanks so much, Chip. It's great to be here again. If you remember, I was also your host last year, and we're going to go through, a lot of similar things that we did last year. So for some of you, it might be a refresh. But these 401k plans are very important to your, future retirement success. And I'll probably say that multiple times today, but these are a really great benefit for you guys. And I hope that comes across through this webinar today. Um, the way we have this kind of structured is we have it broken down into three categories. First, we'll start by, just going over what our 401ks in general and how they work. And then we'll talk about the specific features that are unique to your plan, the WingSwept 401k plan. And then finally, we'll talk about the investment options that you can choose from within your 401k plan. So again, I hope this is, we're going to be going over a lot of numbers, facts, figures, things like that. So I'll try to keep it exciting and engaging. But please make sure you ask any questions. We've been doing this a long time, and I know people can sometimes feel hesitant to ask. But believe me, there's, no question that would surprise me or, would make me considers, you're behind the curve in any way. Everybody's here to learn, and we want to get the most out of this plan for you. So first, let's kind of talk about the benefits of 401ks in general, not just the WingSwept 401k. The first thing is it allows for systematic savings for retirement. So, one of the hard things about investing for a lot of people is they tend to want to time the market. If the market's real high, they're like, oh my gosh, maybe I'll wait for a drop. Or if the market's dropping, they're like, oh my gosh, it's going to keep going down further. I can't get in. So really, it's an easy way to kind of break that pattern of thinking because timing the market has really never been successful for anybody. So what you do essentially is you set this up on the front end where a certain amount of your pay will go directly to the 401k, and then that will get invested according to the investment options that you set up in advance. So it's really kind of you could set it up and forget it for a bit, but you want to keep an eye on it and monitor because as we'll talk about, as life changes, you want to make sure those investment choices are right for you. So this is a real easy way to kind of remove yourself from the equation and kind of make it very simple. 401k plans also allow for tax deferred contributions. Now, what that means is that your contributions to the plan can reduce your taxable income. So let's say, for example, you earn $200,000 per year. and you put in 10%, then your taxable income before the standard deductions and the itemized deductions would go down to $180,000. So you kind of get that tax advantage up front. Now, on the flip coin of that, when you take your withdrawals in retirement, every dollar that you withdraw in retirement will be taxable at your income tax rate. So what you're essentially doing is avoiding taxes today and then deferring them and paying them when you're in retirement. On top of that, you also have and that's called a traditional type approach. On top of that, you also have what's called the Roth contribution approach. Now, the Roth contribution approach allows you to defer money to your 401k, but you do not get that upfront tax advantage. So if you make $200,000 a year and you put $20,000 into your Roth, your taxable income before all the other deductions is still $200,000. The nice thing about that though is in retirement, if you take a qualifying withdrawal, you could take not only what you contributed to the Roth out tax-free, but also all the earnings it accumulated over the years tax-free. So it's a really great benefit and something, people can choose between. Typically what we suggest is, if you're in a high income tax bracket today and a low one in the future, well, you expect to be in a low one in the future, then you should take that tax advantage today. But if you're in a lower, like a zero or very low tax bracket today, the Roth contribution approach could be very appealing to you because you wouldn't really be missing out on any tax advantages today, and then you wouldn't have to deal with taxes at all if you take those qualifying distributions in retirement. A few caveats to note, though, is that we, of course, don't know what future tax rates will be. So that's always, something that's a variable. And, we also can't control what Congress does with tax law either. So, really what we're trying to do is plan as best we can on the things that we control and what we know today. But those are kind of the two approaches that we use to get money into your plan and the tax implications of each. Um, your plan also gets a matching contribution from WingSwept, and we're going to go that into detail here in a bit. But this is maybe one of the most powerful and beneficial things of the 401k. So I really want you to take advantage of this and know about it. And then finally, um, inside of 401k, a nice plug for us is we have a lot of really good investment options, anything from very aggressive to very conservative. And then we could be anywhere in between. We feel really good about the options that are inside your plan that can help you, given your unique circumstances, achieve your retirement goals. Okay. So 401k contribution levels for 2026, they have changed since 2025. So a little bit different this year. So you can contribute 100% of your compensation or $24,500 in pre-tax or Roth contributions for the year 2026. Now, for those who are age 50 and above, you actually get what's called a catch-up contribution of $8,000 per year. So your limit is actually for 2026, 32,500. And as we went over last year, this was new last year, and this was part of the Secure 2.0 Act, I believe. And I'm not sure how they came up with this again, but if you're between the ages of 60 and 63, your yearly contribution can be 35,750. Now, there is something new for this year that I definitely want folks to know of, and that's for those who, and I'll just kind of read the wording here because it's a little bit of a finicky rule, but catch-up contributions for those who earned $150,000 last year in FICA wages from WingSwept must be a Roth. So if you think you're in that category where your earnings were there and your age is there, then please make sure you ask us or Nick, and we'll be happy to make sure you're abiding by the law correctly. But there's a little nuance there. But please be aware of that and reach out if you have any questions. So here's just some of the things that you need to remember when you're contributing to your 401k. your money in your 401k plan is not readily available, right? So the government kind of, sets the rules for these. And, what they really want you to do is put this in here and let time be your best friend and let this continue to grow, grow, grow as you approach retirement. So they kind of make it a little bit difficult for you to get to your money. There are exceptions. And typically the age where you can access it is around age 59 and a half, with avoiding penalties. But please keep in mind that if you did a traditional contribution, so you've got the tax benefit up front, and you take a distribution that's not qualifying, so something such as before age 59 and a half, you could be subject to income taxes and a penalty of up to 10% of that withdrawal, right? So if you took maybe $10,000 out, and you're in a 32% tax bracket, you might owe, $4,200 in taxes, which is a pretty significant bite. So please keep that in mind when you're making your contributions to also make sure that you have money outside of these retirement accounts that are readily available that you can get to. Rule of thumb that a lot of people use is, 6 months of expenditures that are kind of, in a liquid, easy to get to, safer type of place, not subject to wild market swings. But that's a rule of thumb. So we've seen, clients do less than that. We've seen clients want to keep, 2 years. So it's really about, your individual circumstances and what makes you feel comfortable as well. But keep in mind that your 401k, until you reach those higher ages and retirement ages, is not the place where you kind of want to rely on to get access to your funds. So let's swing over to the WingSwept 401k plan. And your eligibility is actually very simple, which is great. So if you're age of 21 and you complete 6 months of service with WingSwept, then you're eligible to participate. So please reach out to Nick and your team there to make sure that you go ahead and sign up once you're getting close to that time frame. For the employer match, now again, this I mentioned this earlier, but this is super important. So your employer will match 100% of your contributions up to 3% of your salary deferred, and then 50% on the next 2% of salary deferred. So, in order to get a full matching contribution of 4% from your employer, you must contribute 5% of your compensation. And we'll kind of talk through those numbers here on the next slide. But something to note, and this is not true for every plan, and this is very nice with the WingSwept plan, is that the employer match is always 100% vested. So the money, as soon as WingSwept puts that in on your behalf, is your money. Now, again, you have to watch the withdrawal rules and things like that. But other plans might make you say, well, this will be officially your money after 2 years, 3 years, 4 years, or whatever the case may be. The money that they put in is yours right away, which is a wonderful feature. And finally, always remember that the match is free money, right? This is on top of your compensation, right? It's not included in your, weekly, monthly pay, however you guys do it. I'm not exactly sure. But so this is, money on top of what you kind of are getting naturally. So please do this, and you won't get this money unless you're acting. So please make sure you're participating. So let's kind of talk through, how this works, the matching works for those who are not familiar, right? So this is for an employee who earns about $50,000 annually, right? So on the left side there, or on the bottom, you have 3%, 4%, 5%, and 10% of salary contributions. So on the far left, a 3% of $50,000 would be you putting in $1,500 of your money from your paycheck, right? So it's reducing your paycheck. And then your employer is going to add $1,500 on top of that, which is not reducing your paycheck and not included in your regular compensation, for a total of $3,000. If you up it to that 4% contribution, you could see that you would be putting in 2,000, and your employer is bumps up to the 17,500. And then at the 5% contribution, you're doing 2,500, and that's where you would get the full employer match And of the 4%, so 4% of $50,000 is 2,000 for a total contribution for your to your 401k of 4,500. Now, of course, there are no rules. You can go up to 100% of your pay. So we're just noting here that if you do 10% and you put in $5,000 of your pay, WingSwep's still going to match $2,000, still going to match that 4% of $50,000. So keep that in mind as well. But the match is a wonderful feature of these plans. And this is to note as well, because a lot of people may not be aware of this, but rollovers are allowed into your plan. So a lot of people maybe had jobs in the past, things of that nature, and they kind of lose track of their old 401ks. And so what I want to make sure is that you guys know that this is available where you can roll that money into the WingSwept 401k plan and maintain those tax advantages, right? If you do a tax qualified acceptable role, you won't be subject to any tax implications. So you want to make sure you're careful when you do this to make sure you don't trigger any trouble with the government. But this helps a lot of people kind of consolidate and then be able to track their money a bit better and stay on top of how things are doing. If you have any questions about that, though, please reach out to us or Nick, and we'll be happy to make sure that we can help you with that and make sure it's done correctly. So let's now get into the investment sections. And so we're kind of that covers, the 401k structures and rules of the game. So let's get into the investments, which are the underlying assets that you're going to choose that will determine kind of the growth, volatility, and things of that nature of your account. Again, let me stress, this is a high-tech graphic as usual, but big decisions overlap with uncertainty can lead to stress. Just remember, we want you to do this. You should do this. This is an amazing feature, and we are all here to help. So please, hopefully these next few slides can build your confidence a bit. But if you still do have questions, oops, I'm sorry, I haven't been clicking the slide here, right there. I'm sorry about that, guys. But if you do have questions, feel free to reach out to us at any time. So let's get into the mutual funds and the underlying investments. In your 401k, we have an investment lineup, and those include mutual funds. So the 401k itself is a structure where the rules of the game are determined. Contributions, withdrawals, tax status, things of that nature. Within the 401k, again, you pick the investments to achieve your goals. For our 401k plan, we're using mutual funds. So a mutual fund is simply an investment vehicle that can invest in stocks, bonds, a combination of each. And every mutual fund has a specific investment objective. So one mutual fund might focus on large US companies, another on small US companies, another on emerging markets or international companies. And bonds work in a very similar way, right? They could focus on different issuers, whether it's a government bond or a corporate bond. They can have different maturity dates, so they could be very short term, 1 to 5 years until they mature, versus up to 30 years. They can have different quality types. So, some are very highly rated and are more stable and predictable, while others might be, have a lot of volatility, uncertainty involved. So really, what these funds do is based on their objective is they provide an easy way to access a variety of individual and stocks and bonds in one vehicle so you don't have to choose them all yourself, right? You're not sitting there saying, well, I want to put 1% in Nvidia, 2% in Apple, and then going down the list. So really, this really helps streamline the situation. So please keep that in mind. So let's take a step back here and look at the basic investment decision process. First, when deciding what funds to invest in, you want to consider things such as your objectives, your investment objectives, your time horizon, your risk capacity, your risk tolerance, all those good things. All those things that go into making a prudent investment allocation. From there, you can structure a portfolio with a combination of stocks and bonds, essentially. And the big thing is to remember here is that you don't have to hold all stocks or all bonds or only one mutual fund. In fact, we encourage you to be well diversified. And what will happen is the combination of funds that you choose will set up that kind of risk return relationship. So let's kind of dive into that a bit here. So the basic investment choices that we have, are stocks, which are ownership in companies. So you're actually, if you buy one share of Apple, you are a very small partial owner of Apple. The other choice is to be a bond investor, which is essentially you're acting as a lender. So the stocks typically come with higher long-term returns, but along the way you're going to see some significant volatility, right? They could be dividend-paying stocks and things like that that could be giving you a little bit of income through time. But really, because of that ownership stake, you're kind of last in line to get paid by the company. And so you're taking the most risk, so you should be rewarded with the most return. And during the course of that, you're going to experience some volatility. Now, bonds typically mean lower long-term returns and more stability. So as a lender, you're getting maybe an interest payment every 6 months, and then when the bond matures, you're getting your money back, right? And you get paid before any of the owners, the stockholders of the company do. So that's maybe a less risky place to be. And so you can expect lower returns from that. Bonds, though, aren't all riskless, right? There are bonds that can default, for example, and those typically are in the area that we call high yield or junk bonds. So please be aware that when you're investing, that if you're looking for something to be a ballast and more of a steady hand in your portfolio, you're not going to really get that with those junk bonds. But you could if you're in something like shorter term treasuries and things like that. So please keep that in mind. So on that risk return spectrum, somebody who is doing 100% stocks, we would consider to be a very growth oriented aggressive type investor, where somebody who is in 100% bonds, we would consider to be more of a conservative income generating type investor. And remember, we could be anywhere in between that 0 and 100% as well. So, the best approach usually is kind of what we call a total return approach, where you're pulling all of these levers to a various degree to help get you. We want some growth, we want some income, we want some stability. Because, in the economy, we're always dealing with a lot of variability, right? Inflation, for example, and things of that nature. So these are just some of the things. And again, we're obviously here to help you through that decision process. So I wanted to kind of give you a read on what you kind of can expect when we're kind of talking about volatility a bit here. And this chart's really showing kind of two things. So let's start from the high level, and that's the four categories there. Small stocks, large stocks, bonds, and then bills. So what the real takeaway here is that you could see that, and these aren't hard and fast numbers, right? You could be up more than 150% in a stock and easily down more than 60% in a stock as well. So please don't think that I'm showing you levels that can't be breached. These are just to give you an idea of how they could work for you. But you see those stocks have a lot more volatility and a lot more upside potential. And then as you go towards the right there, towards treasury bonds, you're not getting a lot of volatility, but you're not getting a lot of upside potential as well. The other thing I'd like to note on this chart is that the small stock, let's look at the small stocks, for example, is the benefit of time, right? So stocks can be very volatile over the short term, maybe like a 1 year holding period. But as you hold that longer through the history of the market, we could see that that volatility kind of settles as you get to that 5 year range and that 20-year range, right? So the downside normally reduces, but then again, at the same time, the upside is down as well. So please keep that in mind, and when you're investing, what I really want you to know from this is time horizon matters, right? If you're 1 year from retirement, right? And you had all your money in these small stocks, that might be really risky, right? Because if the market has a big correction right before you retire, that's going to be a problem, right? So we want you to really think about your time horizon when you're setting up your allocation as well. And finally, I have to always note the benefits of compounding because this is one of the most powerful things in investing. And really what we're saying here is start early. So let's say that, oops, sorry about that. Let me see. There we go. So that let's say that you're going to go up to age 65 working, and during that time period, you earn a 7% return on your investments per year annualized. So you can see there, Joe at age 30, if he's putting in $550 a month for the next 35 years, he's getting close to $1 million. So, what we're saying here again is start saving early, be consistent, and be long-term focused, right? Let time be your best friend. And, with that gray bar there under Joe, for example, if he does that $550 per month for the next 35 years, he's going to put in about $231,000 of his money. And if it grows 7%, again, no guarantees. This is just a hypothetical. We don't know what the market will do, but if it does do that 7%, that 231 will turn into $1 million, about $1 million. So it's very powerful. Again, that's why investing, outside of what you hear in the media and stuff, this is the real power and the real benefit of investing. Okay, so at this point, I've given you a lot of information, a lot of ideas, but what do we do now? We actually need to choose something, right? And what I want to say about that is, everybody's talking about FOMO right now, fear of missing out, and I mean, it's everywhere you look, and it seems to be driving markets today. But you really have to remember that, what did great last year is more than likely not going to be the leader next year. It might even be the laggard. So don't pick things based on what they have done in the past. There's really no correlation between past and future performance. And especially if you're kind of, chasing returns, right? That's probably the most risky proposition there is because that's when things get what we call really extended and are ripe kind of for a correction. We don't know when that would be. It could keep going up for a time period, but through the course of history, you see, things come back to what we call a fundamental level of reality, right? So please don't be a fad chaser or trend follower. All right. So within your 401k plan, we've kind of divided up your ability to select investments into three categories. The target date funds are kind of a one-stop shop, right? That's where you can go pick one certain fund and be like, okay, this should work for me. And then we set up what we call objective-based investments and then customized investment options. So really what we're trying to get at here is, you know, how comfortable you are with the investment selection and how much time you have to monitor your investments could kind of help guide your decision on what you should do within these categories and where you should be. So let's kind of talk about the specifics here of each. Okay. So the target date funds are kind of an all-in-one diversified approach. It's going to contain a mixture of not only uh, large company stocks, small company stocks, international stocks, but also bonds, various bonds, treasuries, corporates, things like that. And so what they do is give you that real easy way to get a diversified exposure. There's currently 12 target date funds within the WingSwept plan. And, if you want an easy way to choose one, if you're planning to retire around the year 2050, you would simply look at and select the fund that is labeled the year 2050, right? Pretty straightforward, right? Now, these target date funds come with an extra feature that makes them unique from objective-based funds, right? They have what's called this glide path. So the bar in the middle there is, your target retirement date. So you expect to retire there, and to the left, you see your years to retirement, so how many more working years you have, and then to the right is the years beyond retirement date. And so on the left side, what you see is when we're a long way from retirement, we're going to be in more of those stock investments, the pink and mustard colors there. And that's because, maybe there will probably be that volatility, but we have time, right? We can withstand that in our pursuit of greater investment returns. But then as we get closer to retirement date, we're going to increase our exposure to safer bonds and cash and decrease that allocation to the stocks in these target date funds specifically. So they're becoming more conservative for you through time. So that's kind of the added feature that, as you go, this fund is going to kind of transition for you, and you don't have to go in there and change your investment or anything like that. But keep in mind too that, your life might change in different ways where even this isn't appropriate for you. So you still want to just be, cognizant of, what you have, and even it's something like this is still right for you. The next level is our objective-based funds, and they are very similar to the target date funds. They are an easy way to get diversified exposure based on your preferences to the various stocks and bonds that exist in the market. And but they have static exposure, right? So unlike the glide path of the target date funds, this will require a bit more monitoring. Inside your plan, you have, oops, I'm sorry, I missed the thing again. There they are. Okay. Sorry about that, guys. I'm not doing a good job clicking today. I apologize. So inside your plan, you have the Vanguard objective-based options. So these are objective-based funds that are provided by Vanguard, and they could be anywhere from very conservative to very growth-oriented. And then we here at Beacon also have set up 4 portfolios for you from conservative to aggressive as well that you could choose from. And really the difference between those is that allocation to stocks and bonds, right? So one of a growth fund might consider something that has maybe 80% stocks and 20% bonds, whereas a conservative fund might be something 20% stocks and 80% bonds. So it kind of helps you narrow in based on your level of comfort what you want. Now, remember, this isn't going to change. So, as time goes by and you pick a 60/40 fund, for example, it's going to stay 60/40, right? And the fund will automatically rebalance itself back to 60% stocks and 40% bonds through time as the market moves. So again, you want to pay attention to this because you're not getting the benefit of this of the glide path. You're getting a static allocation, but it is kind of one of those all-in-one investment solutions. And finally, we'll talk about the customized investment options. And so we have quite a few of these in your investment lineup as well, quite a few mutual funds that you can choose from. And what these are right for are the people who are kind of choosing, monitoring, and feel comfortable adjusting those investments themselves, right? So you might pick a fund that's international stocks, a fund that's large stocks, small stocks, and a couple bond funds, and then put a certain amount, a percentage of your money into each, and because that's what you feel is right for you, and that's your right to do so. But keep in mind too that you want to stay completely on top of this. We're looking at these investments and making sure that they're prudent for your 401(k) plan. But again, the reason why we get returns in any asset that we invest in is because we're going to be subject to risk and volatility, right? We can't control that. So you want to make sure that your allocations are right based on that. In addition, sometimes the customizable investment option approach is best for um, client or employees who may have assets outside their 401k, and they might say, oh, well, I'm awfully heavy in these kind of stocks over here, so maybe I want to focus my 401k on these types of stocks to kind of make it balanced out and get a more diversified approach. But again, this is definitely for those people who are big on a do-it-yourself kind of approach. So we always kind of like to, we're near the end here, and we always kind of like to show a little bit of a historical graph of, and I think we all know this, there's always something going on in the world, something to be worried about. No one saw COVID coming 6 years ago now. Wow. No one was really anticipating the scale and scope of tariffs last year and last April when the market had about a 10% correction in 2 days. But, at the same time, putting money in consistently is the best approach because, as for example, in last April, we had 2 rough days and the market pretty much very, soon bounced right back, and it ended up, depending on what index you're looking at, but up over 15% for the year in total, right? So if you would have let that kind of spook your nerves a bit and you got out, you would have actually missed out on not only the recovery, but an extra 15 or so approach, a 15 or 15% growth overall in your money. So overall, reevaluate your investments periodically to make sure they're right for you as your life and goals change. Even the target date, don't forget about that. And you can always come talk to us. And remember, you can always log into your investor portal, and there you can change your allocations, right? So if you're contributing 5% of your pay and you want to go up to 10, you can do that online. And then you can also at any time go in there and change your investment mix, right? So you can just log in and do that. Or you, of course, can call us and we can help you as well. Finally, this is our last slide, and this is something that people forget because it's so easy and it's so easy to overlook, which might be a big problem, right? And that's to make sure that you put your beneficiaries on your account, your 401k. So if something were to happen to you, that 401k account would go to the beneficiaries that you have listed. The 401k beneficiaries that you list actually have priority over anything that you write in your will regarding that 401k, right? So 401ks, retirement accounts where you name a beneficiary take precedence over anything you write in a will. So that's why it's so important that you want to make sure that those beneficiaries are what you want. And then also to remember that you can name, and you should name contingent beneficiaries as well. So Chip, I think that's it for me. Um,
Yes, thank you, Dave. That was very informative. And just to reiterate again, the beneficiary designation is pretty huge. We've seen over the years many times where people have, parents, or I've seen an ex-spouse before. So just make sure you review those. It's a super important thing. One of the questions that I thought of as we were kind of going through this, and one thing that we get a lot from people is, how much should we be saving? What percentage should we allocate to the 401k plan? And I think that's a good question. Dave, do you want to have any thoughts on that?
so a lot of people will say, a good rule of thumb, for example, is 10%. But again, really, it goes into a lot about your personal circumstances as well, too, right? How old you are, how much you like to spend, what you envision your retirement to look like. Longevity. What's the longevity like in your family? How long can you expect maybe to be around? I know there's no guarantees, but these are all the things that you want to kind of think about as well. So, rule of thumb, maybe 10%. But again, if you could do 1%, please do that. Next, if you can do 5% to get the full amount of your free money match from WingSwept, please do that. And then feel free to take it as high as you possibly can and want to from there.
Yeah, that's a good answer. And, increasing it over time. This year you do 5%, next year you do 6% with the goal of eventually maxing out your contribution level. I think that's a wonderful aspiration and something that would certainly help you in the future, especially given the quality of the investments and the quality of your 401k plan. Had a question, are we on call? Is Beacon on call for advice? No, we're here to advise the plan in general. We do give general advice to participants. The one-on-ones I think would be helpful if you have something specific. We can kind of point you in the right direction if we do that. So, but we would not be available to take kind of ad hoc questions just on demand. So, with that being said, I think that that's all the questions. Dave, again, is going to roll into the one-on-ones as people have scheduled. Don't hesitate to do that. We love meeting with individuals. That's the best part of the job, honestly. So, but thank you so much for your time, and don't hesitate to reach out to Dave in this next hour. And
Yep.
we look
Thanks,
forward to
guys.
talking to you soon.
Thank you.